It's been a little while since we came to talk to you on some of these updated and recent announcements, which is in general a good thing, right? No one likes your accountant to be really good at being able to come last minute with updates and recent changes, because as accountants we like things to be steady and consistent, which has been very nice. But we wanted to come to you today to talk a little bit about some of the new pronouncements that are coming in the media here, particularly the one related to the Inflation Reduction Act, or the IRA. Not to be confused with other IRAs, right? Thank you for that. So by the time you see this, we know for sure that it's been passed by the Senate, and it's likely to be passed by the House and then by the President as well. And so it's hard for us to come a little bit in the middle of this, but we're getting enough calls wondering about this that we thought it was important to bring to you. The key topics actually that I'm going to go through in this video are going to deal with what's in the bill, but then also what it's not. And what you're going to find is most of the implications for you that are watching this are it's in the not part. And it's particularly related to the corporate tax increase. That's very scary for a lot of individuals, and you're going to find it actually doesn't apply as much as you may think it does. So let's start with saying what's in the act. So the clean reduction and emissions part of the act, which is promoting renewable energy. Many of the tax incentives and the increases that are coming there are actually extensions for things that are already in place. So it's continuing on the production enhancements tax credits, it's continuing on the renewable energy tax credits, and it's continuing on other incentives that are out there for methane gas reduction, for coal enhancement reduction, all of those things. So it continues on what's there and extends those beyond. Now, it's interesting to know, and for some of the oil and gas and enhanced recovery or the renewable energy side of the clients that we're talking with, that there's going to be a lot there for you to digest and impact and the impacts. But most of you watching this video aren't going to really understand or aren't going to want to spend the time to know that, other than just know that they're pushing on extending for renewable energy and incentivizing those. Some of the ones that could impact you at the level is going to be the extension and the continuation on the tax credit related to vehicles. So electric vehicles, there's a $7,500 credit available for the purchase of an electric vehicle. That was set to phase out. It is being continued on, and they're also adding in a new $4,000 tax credit for the purchase of a used vehicle. Now that actually still has a little bit of difficulty in it, if you ask me as a tax preparer, just seeing how that's going to rework its way through to avoid various different things. So we're not quite sure on all the details, but know that that's there, which is, if you're in the market for an electric vehicle, is something definitely you're going to want to consider and think about. In addition, they're extending on the renewable energy credits for home efficiency. So in your, if you put a solar panel on your house, or geothermal on your house, or a high efficient furnace or hot water heater, things like that, they're extending those on. Again, none of these are new other than that used vehicle $4,000 one. They're just extension of what's there already. So that's the key takeaway of what's in the bill. Now, what's also in the bill that's going to pay for this, and where most of the angst is coming in, the people that I talk to, are A, how it's going to be paid for, and then within that, how does that go there and how does that impact you? So one of the ways they're going to pay for all of these credits is by funding more audits. They're going to fund the IRS to then spend more time in more compliance. Now, that sounds scary at first, and I agree it is. More audits is never a good thing. Other than, I would say, if you're taking the time out of your day to watch this video, you're likely not an individual that's going to be in the receiving end of these audits. So where these audits are going to come is non-compliance. It's going to be for the individuals that aren't filing tax returns for the last 5 or 10 years. Or it's going to be for the highly aggressive taxpayers that may have significant expenses or deductions that they've taken that aren't warranted or aren't allowed. It's going to be very focused and very specific on where they're going to go. There are a few others, particularly if you look at carried interest, which is a more complicated tax structure that you can do for hedge funds. Again, that's going to be a focus area, I think. You're going to see some other focus-specific items. Non-compliance within 1099s or subcontractors. That I do see. So if you're an individual that is playing and pushing the game on using 1099 subcontractors versus employees, that could become a little bit more risky. But the general population out there likely will not see much impact on this. And the best way to look at that is think of cost, value, and benefit. The whole reason that they're trying to fund more dollars to pay for these is so they get more dollars back. It's a return on investment. So if the IRS is going to spend the 3 weeks worth of wages to someone to audit them, it has to be worth what they're going to find. So if on average you're paying $4,000 a year in taxes, they're not going to spend the time to figure out what more they could owe, because maybe they get another $500. Well, it costs them $1,500 to get that $500. Now, I'm making up numbers here, but it's just trying to provide an example, because you add a few zeros or otherwise. But the way to think of that is it's not going to really impact most of you that are watching this. Just be cautious, just be aware, and certainly if you're working with us, we're going to be talking through on what's allowed and what's not allowed. And so in and of itself, just using a professional tax preparer is going to likely get you in a position where you're okay in this sense. Now, let's shift to the biggest item within this bill, and that's related to the 15% corporate tax, as well as the 1%, and this was just newly added at the very end here, it's the 1% excise tax on corporate buybacks. Now, when you hear corporate, what I need you to hear in this particular case is truly large corporations. So there's a $1 billion threshold on this. So most of you watching this video are not going to reach the $1 billion threshold on your businesses. And so you don't have to worry. Now, I don't want to say that it's not going to impact you. Far from it. Where it's going to impact you is you as an investor. So these big corporations, who owns these big corporations? Your retirement account, your pension fund. But where it's going to impact you is your returnings in your investment portfolio, not you as a business owner. So it is there, and you are certainly going to feel it, but not as a business owner, rather as an investment. Because this corporate tax is truly for the large corporations. And what the IRS is doing, and they've started doing this more, is merging into it, and they've done this of recent on a couple other recent announcements, is they're trying to mirror or more closely align with what corporate America is presenting to Americans, which is GAAP-based, or generally accepted accounting principles. Put another way, when you hear on the media, on the news, and they say, well, Ford just announced their earnings for this month, in this quarter, or Disney announced their earnings for this quarter. Well, those announcements and those earnings per share and those earnings are based on GAAP, not tax. And so what they're trying to attack is say, hey, they're trying to make themselves look really good, right? Because you as an investor want to hear positive news. And so they're saying, hey, we made $1 million last year. But oh, by the way, on the tax side, we lost $3 million. So they're trying to say, hey, how could it be that you're presenting one piece of information to one set of individuals, the investors, and it's always positive, and then you present to the IRS, it's always negative. And so they're trying to peel those together. And so what they're doing is they're putting a minimum tax in. And they're saying, well, if you present information to the investors that you made $1 billion last year, but you present to the IRS that you lost $1 billion, they're going to say, nope, we're going to go over here and look at the fact that you presented you made $1 billion, and they're going to use that number. Now, as can be imagined, there are a slew of complications that come within that. One example would be foreign, right? So if you look at these big corporations, they are multinational. And so this is just the US tax we're talking about. Well, how do you present the conglomerated, consolidated information inside of the US only? There's other complications that are come with it. The key takeaway that you have to hear today is that this does not apply to small businesses. Even if you are a C corporation that we work with, I can tell you, I do not work with any C corporations that this is going to fit into as a business owner, right? Again, $1 billion threshold. Hear that? B with a B, or $1 billion with a B. It's going to impact you, but it's going to be as an investor, and nothing you can do about it. It's just going to be more returns. So it's real, it's there, but nothing that you have to change in your business that you are running day to day. The second part here is also the corporate buyback, and that gets into, of recent, it's become very popular when all of these corporations have big dollars that are out there, and they can either deploy them buying equipment, buying other things, or they buy back shares. Berkshire Hathaway is a huge one that does that, right? They always say that we're never going to push a dividend. They're going to only do corporate buybacks. So what they're trying to get into there is these corporations that are choosing to not reinvest, rather buy back stocks, in a sense, not paying taxes. That's why Berkshire Hathaway does that, is they say it's the most tax efficient way, is they're hitting into that. And they're saying, yep, let's take advantage of this. Again, if you have stocks that are highly based on corporate buybacks, it's going to lower your investment return potentially within that stock, but it's nothing you're going to do directly other than talking to your financial advisor of what are some of the implications of an after-tax investment and return in your portfolio. Well, that was a lot there, and I will tell you again, this is still in draft form when I'm writing this. It's likely going to have been passed, but even when it is passed, that's still the legislation, and so how it rolls down into the tax actual side of things, we shall be seeing. But I mainly wanted to come to you because of the amount of questions that we're getting, and is, well, how does this apply to you? And hear from me, by and large, it's not going to apply to most small business owners on things that they can do. So thank you for joining us. If you still have questions and you want to talk through on your specific example, let us know. That's what we're here for. Give us a call. We love talking to you, and we look forward to hearing from you. Thanks.